Assalamualaikum and very good evening to our beloved lecturer Mr. Muhammad Arif bin Abdul Rahman. First of all, we would like to thank to you because giving us this opportunity for making a very interesting video. Our topic is about capital budgeting. First of all, we would like to introduce our group member, me as a first presenter, Siti HAJAR binti HASHIM, followed by second presenter, Siti NURFADZILAH binti FADZIL, third presenter, NABILA binti AB HAKIM, and last but not least is ROZIATI binti Muhammad SALLEH. Okay, before I proceed our presentations, our overview of this topic is about the definition of capital budgeting, method that we are used for making a capital budgeting, and when we do some calculation, how many steps that should we include in the capital budgeting. Okay, what is capital budgeting? Okay, most of this chapter is about the criteria that the company use to decide whether the project to go forward with or what project should not be executed. Okay, for example, what we're thinking about when we are doing a new project for our business. Okay, capital budgeting is when we ask ourselves, is it worth it to put the money or the capital into this project? Or is it a good decision, or is it a good deal in terms of money or in terms of earning to put the money in this new project? So the definition of capital budgeting is a process of analyzing projects and deciding which one to include in the capital budget. Okay, that means what project should we do and what project should we not to do, or is it good enough to use the money to buy a new machine or to buy a new building or to invest to the project? If yes, okay, how much of this machine will we earn for every year if we compare to the cost of getting money to buy the machine? Okay, next I will explain about the capital budgeting decisions. As we all know, the capital budgeting method is divided into 4 categories, which are ARR, B, payback period, C, IRR or internal rate of return, and D is net present value. Okay, for our video, we will cover payback period and also net present value as well. Okay, before that, I would like to explain about the independent project and mutually exclusive. When we want to decide which project we would like to do. Okay, we have to make some calculations. Okay, after we calculate it, and if after we calculate it, it can be conclude or it can be decided into two decisions. First decisions, whether it's an independent project or whether it's mutually exclusive. What is meant by independent project is, for example, if we have a project A and project B, okay, the company may choose the both project. Okay, that's its independent project all about. But for mutually exclusive, we only choose either project A or either project B or neither both. Okay, for make some clear, I have prepared the example of the capital budgeting. And okay, as we can see, the example is about complex number hut is considering replacing a 4-year-old machine that originally cost 200,000 with a new and more efficient one. Okay, the old machine has a salvage value of 2,000 over 9 years useful life. Okay, it could be sold today for 80,000. So the new machine would cost 350,000. It is expected to have a useful life of 4 years. The imported machine is expected to incur freight charges of 5,000 and insurance of 12,000. At the end of the useful life, the machine is expected to have a salvage value 11,000. Okay, the company's policy is to provide annual depreciation based on straight line method. To buy this machine, the company has to borrow 300,000 from RHB Bank, of which 2,000 interest is paid per month. The new machine would increase operating capacity, which means the inventory level would be raised by 35,000. In addition to that, short-term borrowing will increase by 21,500. The forecast sales from the project is as follow. From year 1 until year 2, it increased by 400,000, and year 3 and year 4, it increased by 480,000. Okay, beside that, the machine will also incur the following projected differential cash flow, which is electricity charges increase 50,000 from year 1 until year 4, salaries decrease 20,000 from year 1 until year 4, manufacturing costs decrease by 150,000 from year 1 until year 2, decrease by 180,000 from year 3 until year 4. Okay, the company tax rate is 25%, and the company's cost is the company cost of capital is 12%. Okay, you are required to calculate the initial outlay, annual differential cash flow, terminal cash flow, and we also need to compute the payback period and net present value. So the first thing we must do is step number 1, we have to extract the information first. Okay, we extract the information from the question given. Okay, based on the question given, they stated the old machines. Okay, cost of old machine is 200,000. Okay, and they have 9 years of useful life, and salvage value is 2,000, and they have another 5 years to replace for the old machines, because if you can see, they said they are replacing 4-year-old machines, and their useful life is 9 years. So 9 minus 4 is equal to 5 years. Okay, their selling price is 80,000. Okay, for a new machine, cost for a new machine is 350,000, and their useful life is 4 years. Meanwhile, their freight charges is 5,000, and they also include some insurance, which is 12,000. And the total cost machine is 360,000 based on additional from cost of machine plus freight charge and plus with insurance. So we got it 367,000, and they also have a salvage value RM 11,000. Okay, for the next step, I will proceed to my friends, which is Siti NURFADZILAH binti Fadzil, for the further explanations. That's all from me. Thank you.
Assalamualaikum. Hi, I'm the second presenter, Siti NURFADZILAH binti Fadzil. I'm gonna proceed with step 2, calculation for depreciation for both machine. There are 2 methods for depreciation. First is straight line method, and second is reducing line method. So based on the question, the company's policy is to provide annual depreciation based on straight line method. So the company is using straight line method. The formula for straight line method is cost minus with salvage value and divide by n. So first we will calculate depreciation for old machine. The cost for old machine is 200,000 minus with 2,000 the salvage value and divide by 9 years, which we can get all the information in the step 1. So equal to 22,000 per year. And depreciation for new machine, the cost for new machine is 367,000 minus 11,000 divided by 4 years equal to 89,000 per year. So that is the depreciation for old machine and new machine. So next is step 3, calculate tax. The formula for calculate tax is cost of old machine divide minus accumulated depreciation, we get net book value, and then minus with selling price for old machine or disposal price for old machine, and we get profit or loss on disposal. So the cost of old machine is 200,000, and for accumulated depreciation, we need to times the depreciation per year with the current age of the old machine, which is 22,000 times 4 years. which we can get from the step 2, the amount 22,000 per year, and step 1. The company wants to replace a 4-year-old machine, so we get 88,000 for accumulated depreciation. So cost of old machine 200,000 minus with 88,000, we get net book value of 112,000. Then minus with selling price for old machine 80,000, we get loss of 32,000. This is because the selling price for old machine only 80,000, which while the net book value is 112,000. So if the answer is loss, it is tax saving. So, and meanwhile, if the answer is profit, it is tax paid. So the formula for tax saving is 32,000 we times with tax rate, which we can get from the question. The company's tax rate is 25%. So 32,000 will times with 25%, we get 8,000 for tax saving. So next is step 4. Calculate net working capital for new machine. So the formula for net working capital is current asset we minus with current liabilities. So based on the question, to buy this machine, the company has to borrow 300,000 from RHB Bank, of which 2,000 interest is paid per month. The new machine will increase operating capacity, which means the inventory level would be raised by 35,000. So inventory is classified as current asset, and in addition to that, short-term borrowing will increase by 21,500. So short-term borrowing is classified as current liabilities. So current asset is 35,000, will minus with 21,500 equals to 30,500, which is increase in net working capital. So that's all from me. We will proceed to third presenter, that is Wan Nabila, Hakim. Thank you.
Okay, third presenter. My name is Wan Nabila binti Abdul Hakim. I would like to explain step 5 initial outlay. They have that formula is outflow and inflow. Outflow is total cost of new machine. Can get from the extra information step 1 36700 plus increase in net working capital 13500. 13500 ni we can get from the step 4 current asset minus current liability. Okay, next, that total is minus into inflow. The formula is minus disposal value 80,000 and minus tax saving 80,000 we can get from the extra information step 1. Okay, next, minus tax saving we can get from the step 3 80,000 8,000. Okay, the total amount is 292500. Okay, based on the question, based on the question, there is no have information about the training cost. But if question give information about the training cost, we just put into outflow. And if on the step 3 get tax pay, it is outflow. And if tax saving is inflow. Let's move on the step 6, annual cash flow. Okay, first identify utilize your new machine. From the step 1, there is given 4 years. Okay, they have two category, benefit and cost. for the benefit is the increase in revenue or decrease in expenses. Okay, for the cost, decrease in revenue or increase in expenses, and change depreciation. Okay, let's do a calculation. Do 4 column because they have 4 year. First, benefit has sales, salary, manufacturing cost. Okay, from the information we can get from the question, electricity charge, salary, manufacturing cost. Okay, minus cost, electricity. Okay, for the charge in depreciation, that formula is new depreciation minus all depreciation, carry forward on the step 2. That total from that we calculate. Okay, we can get 67,000. Okay, next tax rate. Okay, tax rate we can get from the information question that given the company tax rate is 25% and the company cost of capital is 12%. Okay. Plus charge in depreciation, that amount same from the charge in depreciation, 67,000. And lastly, we can get terminal cash flow. Okay, how to calculate is for the first year, 400,000 plus 20,000 plus 150,000 and minus 50,000 and minus 67,000, we can get 453,000. Okay, minus 113,250. Okay, back plus 6700, and that's total amount we can get 406,750. Okay, for the next year 2 and year 3, year 4, that calculation is same. Okay, lastly, terminal cash flow, that formula is servant value plus net working capital. That's the amount we can get 24,500.
Assalamualaikum. My name is ROZIATI binti Muhammad Salleh. I as a last presenter. Okay, my part is to calculate payback period and net present value. What is payback period? Why we need to calculate payback period? Because we want to know how long we get back our money for this project. Okay, first step, we must to construct the table. So how we know the year, we take from the step 6. So 0 to 4. So for amount cash flow for year 1, year 2, year 3 and year 4, we got from the step 6, and the amount for IO for for year 0 we got from step 5. So the last year is year 4, right? So for year 4 we must to plus the amount of terminal cash flow. So the amount is 24,500. So this amount after we calculate. So for CCF of cover cash flow is year 1, because year 1 is can cover the amount of 292,500. Okay, now we move to calculate payback period. The formula is N minus 1 plus IO minus sum of cash flow before N over cash flow under N. So N is amount, N is year we cover the cash flow is 1 minus 1 plus 292,500. This is IO we got from the step 5, or we can get for this year 0. So you see this negative, right? We must ignore the we must ignore the negative, just put the amount of positive. Minus 0. Why I minus 0? Because we cover the cash flow is year 1, so before 1 is 0, that's why I put 0 over 406750 is the amount of we cover the cash flow. Okay, so equal to 0.72 year. So this year is we can get our money back. Now we calculate the present value. Okay, present value is the time value of money. In order to use this method, we have to know how to use the time of value table. Okay, PVIF is mean present value in factor. So this percent have already given in the question. Okay, this amount we can calculate from the formula. Use a formula or just use a table. So formula is 1 over 1 plus C times N. Okay, so how we get this amount? From cash flow amount this we time with PVIF, so we got this amount. From this amount we got the total present value. Okay, we need this not done yet because we need to calculate net present value. Okay, the formula of net present value is total present value minus IO. So this amount 13621x4.46 minus 292500 equal is 10696x4.46. So this is amount. So the amount is positive. That means this project should so we should accept this project. But if we get the negative amount or negative answer, that mean project is not worthwhile. Okay, last is thank you for watching our presentation, and I hope all of you enjoy watching this presentation. Thank you.
Ni kau present balik.